All right, in this video, we're going to talk about the no-lose trade, the can't-lose trade. I'm going to show you an actual trade that I just put on the other day where I cannot lose. I can make money if the stock goes to zero, and I can make money if the stock goes all the way to as high as it can go. Now, just so you know, this is not a trade that only I can do or only option trading professionals can do. These types of trades are out there. So if you want to learn how to protect your position, your stock position on the downside, and also make money on the upside, I'm going to show you how it works. So you want to learn how to do this, stick around and watch this video. And let's go. All right, everyone, Lee Lowell here from smartoptionseller.com. Yes, what you see on your screen is our latest cheat sheet on the Smart Option Seller Guide to the collar trade. For those of you that don't know what a collar trade is, it's a very simple option trading strategy in which you're long the stock, you sell a call option, and you also buy a put option all at the same time. So you got three legs right there. It's just like a covered call trade where you buy stock and then you sell a covered call. But this adds a third element of buying a put option to protect you on the downside. Now, if you set up the legs properly, you can be completely covered where you won't lose any money if the stock goes down. Even if the stock goes to zero, you'll still walk away winner. And if the stock goes up, you'll still make money, except that your profits will be capped on the upside. So it depends on, what you're looking for in this type of trade. If you're a short-term trader or, you don't really care if your profits are capped, then this collar trade could be for you. Now, if you're a long-term stockholder and you want to see as much price appreciation as you can, well, the covered call end of the trade might cap your profits, but you can always roll that covered call. But I want to show you this trade as it is, as the collar trade. So the way it works is that you buy shares of stock, you sell a call option out of the money, where the strike price is higher than the stock price, and you can buy a put option either at the money or a little bit out of the money or even slightly in the money. It all depends on the prices of the options, where you have to finagle them a little bit to see, what each option is trading for, and that way you'll be able to know whether you're going to make money all around. So let's go look at our our cheat sheet here and talk about what this is. So the collar trade is used to protect the downside of a long stock position, but it will also cap the upside, as I just said. The setup is to buy stock. You got to buy the 100 shares of stock, at least 100 shares, because you're going to be playing with option contracts that represent 100 shares of stock. So you need to have the money to cover the 100 share purchase. So you buy 100 shares of stock, you're going to buy a put option, and you're going to sell a call option. And like I said, if you construct it properly, you can be protected all the way around. So let's go and take a look at the actual trade that I did. Scroll down here. It's on Tesla. Yes, everyone's favorite Tesla. So we're going to talk about it. I'm going to walk you through the numbers. I'm going to show you the actual trade confirmation from the broker so you know that I actually placed this trade. So here's how it works. I bought 100 shares of Tesla the other day at $267.36. So that was an outlay of cash of $26,736. At the same time, all within the same trade. You can do a collar trade, all three legs at the same time. You don't have to do the stock and then buy the put option and then sell the call option. You do them all together in one trade for one total spread price. Okay, every broker you can do this with, no matter who your broker is. Now, if you want to know who I use, Interactive Brokers is one of the brokers that I use, and I have information about them down below. If you want to click on the link, you can learn more about Interactive Brokers, and I'm going to show you the option chain in a minute. So what I did is, I bought 100 shares of Tesla, then I bought one contract of the December 2023 270 put option for $31 a contract. So that was another outlay of $3,100. And then I sold one contract of the December 2023 280 call for $29.31 per contract, which brought into me $2,931. All right. So the legs, the option, if you're doing more than one option, they're called legs. So both legs were done in the same month, different strike prices. Okay. So no matter how high or low Tesla goes in the future, I'm guaranteed to make money. Okay. So let me first show you the screenshot of the broker statement here. So the other day, July 25th, Tesla bought 100 shares of Tesla for $267.36, and I sold the 280 call for $29.31, and I bought the 270 put. You can see right here, put call for $31 per contract. And here's, I have debits, 2 debits and 1 credit. Okay. So let's go back to the cheat sheet here and we will go over the details. Let me move myself here a little bit. Now, let's go over the calculations. We're going to start with Tesla going completely bankrupt and if the stock drops to 0, and I'll show you how the numbers work. Now, if the stock drops to 0 and completely goes out worthless, I'm going to lose all my money on the stock purchase. Okay, so that means I'm going to lose $26,736 on the stock purchase. That's the amount of money that I put in to buy the shares of stock. But the put option is what saves me. Okay, since I bought the 270 strike put, that means I get to sell Tesla for $270 per share. Okay, but I have to subtract out the $3,100 that I paid up front to buy that put option. So in the end, if Tesla goes to 0, I'll make $23,900 on the put option. Okay, so how you figure that out, you got 270 strike all the way to 0, so that's $270 per share that I'm going to make. But once again, I have to subtract out this amount. So that's where I come up with the $23,900 to the positive. Now the call option that I sold, that's going to go out worthless. So I make all the money on that, the full $2,931. So if you add all 3 of these numbers together, I'm going to come out $95 to the positive. Okay, so if Tesla goes to 0, I'm still walking away with an extra $95 in my pocket. Yeah, that's how great the collar trade is, especially if you can construct it this way. Now, if Tesla stays right at $267.36, what happens? Well, I'll make $0 on the stock purchase. I won't lose any money, won't make any money. I'm going to lose $2,836 on the put option. You know, I'll still get to sell Tesla for $270 per share while Tesla's, currently at $267. But taking away from that profit is the cost of the put option. So once again, I have to subtract out the cost of the put option. So the put option will actually lose money in this case if Tesla stays right where it is. I'll lose $2,836. And once again, the call option will expire worthless, and I'll make all the money on that whole sale of the call option. Once again, add these numbers together, and it comes out to positive $95. That's if Tesla doesn't go anywhere in the future. Okay. Now let's take a look. If Tesla goes up to $300 a share, what happens? Well, I'll make $3,264 on the stock purchase itself, which is great. Now, I will lose the full amount on the put option. The 270 put will expire out of the money, so I'll lose the whole $3,100 that I'll make on that. I'll lose the whole $3,100 that I had paid for the put option. Now, the call option is at $280. So that means I have to sell Tesla at $280. But since I collected the $29.31 for it, that buffers the loss that I'll take by having to sell Tesla at $280, right? So you add up all these numbers, and once again, now on the upside, I'll make $1,095. Okay, so the stock purchase helps a lot in this case. I lose all on the put option, and I'll make a little bit on the call option. Okay, so just remember, you got stocks at 300. I have to sell it now at 280. That's a $20 per contract loss, per share loss. But I already took in $2,900 when I originally sold the call. So I more than made up from the original sale of the call than I would lose if Tesla goes up to $300. So on the upside, it's $1,095. So anything over $280, that will cap my upside on the stock purchase. You know, I own 100 shares of stock, So Tesla can go up forever. I'll make all that money on the stock purchase, but the call option is what's going to hold me back. But the max gain I can make on the upside is $1,095. So I'd rather have Tesla go up because I'll make $1,000, $1,095 versus it goes down. I'll make $95 even if Tesla goes bankrupt. Don't want to see that happen. But anyway, so in this case, so for me here, the max profits would be reached if Tesla moves above $280. So what you can do is you can fiddle around with different strike prices, different expiration dates, see how much cushion you can get by which put option you'll have to buy and which call option you sell. All right. So there's a lot of different things you can do. So let's take a look at the option chain here. And this is the option chain in Interactive Brokers that I use. So we've got Tesla here. So at the time of filming this video, the market's closed, but Tesla went out at $264.60. So if you want to try to figure out how to do trades like this, and this is just an example, this is not a real trade, although I did execute that trade for myself, it is not a live recommendation. So I just want to make sure everybody understands that. So what you have to do is, so if you were to buy 100 shares of Tesla, that would cost you $26,457. Now you can choose any expiration date you want. You probably need to go out a little further in time to be able to get, a little wider buffer zone, but you play around with the numbers. You have to take pen to paper sometimes and write out every scenario so you actually know, or you can do it online through a website where you can put in each position and it'll tell you and it'll show you the chart and everything. So, if Tesla's at 264.58, then you may want to look at the 265 put or the 260 put to purchase. That will protect you all the way on the downside. But you want to figure out which call options should you sell that will, buffer or give you income against the purchase of the put. So the sale of the call and the purchase of the put, are typically going to be close together as long as they can cover you on the downside. Okay, so like I said, you want to play around with some of the strike prices. The 265 puts would be the at the money strike, or you can look at the 260 put and either the 270 or 275 calls. So there's some key things here that you want to make sure. If you want to be completely covered on the downside, you have to make sure the price of the call will offset price of the put that will protect you. So if you were to buy Tesla at $264.58 and you were to buy the 260 puts, meaning once Tesla falls below 260, you're completely covered. But you want to make sure that whatever the cost, let's say this put cost $26.40 and you sell let's say the 270 calls against it for $31.15 or so, that's about a $4.75 credit to your account, which will cover you for the $2 at, the 264.58. You're going to sell Tesla at 260, but you're going to get a credit of $4.75 between buying the put and selling the call. So you'll actually come out ahead about 17 cents. So you'll make about $17, if Tesla goes bankrupt on the downside. So you have to figure out the cost of the put versus the sale of the call and how much credit you'll get versus, where you'll end up selling the shares. At 260, you'll sell the shares. You're buying them at 264.58. You think that's going to be a $4 loss, which it will on the stock, but the credit of the call sale and the put buy is $4.75 roughly. So you're going to cover that $4.58 loss on the downside. So like I said, you come out about 17 cents ahead, or $17 in the end total. So there you go. That's how you do it. The collar trade is a very common trade. A lot of people do it, but a lot of people will do it not the way that I'm showing you, where you can come out ahead all the time. Most people buy the stock and they sell a much deeper out of the money call option because they want to give that stock, opportunity to rise, and they'll buy, a more of out of the money put. Let's just say if you bought Tesla, that's 264, and you have, let's say, a 20% stop loss, which would be about, $52. So maybe someone would buy a $215 put and sell the, I don't know, maybe a $320 call option, whatever, because they want to have more chance for the stock to appreciate, and they're willing to lose money, like a 20% stop loss. You'll actually lose money, but you'll have a wider area for profit on the upside. So it all depends on what you want to get out of the trade. In this specific case, I was doing this more for example sake. And so if Tesla goes above 280, which it can certainly do, my upside's going to be capped. All right. So that's all for this little exercise here, this little lesson. Let's go back to the cheat sheet here. Once again, talk about what it is. The collar trade. You got to buy the stock. So you got to pay for the shares, and you're going to sell the call and buy the put all in a single transaction. Not hard to do. All brokers will allow you to do this. All right. I know this is a very interesting trade, but it's a very common type of trade. So don't, get all crazy and think that you're never going to be able to do this, because you can do it if that's what you want. All right. So let's take a quick look at our website, smartoptionseller.com. Even though we're talking about a collar trade today, you know that at the Smart Option Seller, we're all about option selling. We sell put options is our main gig. So go to our website, click on the Put Selling Basics link here. If you've never heard about put selling, get our free ebook. Scroll down here, read a little bit about it, put your name and email address in here. We will send you an email with a link to download the free copy. We love put selling so much. That's what we do. In our services tab here, we run 2 newsletters. We run a put selling newsletter, and we sell put option credit spreads, all about put selling. We have our one-on-one coaching sessions. Got a lot of students lining up to learn from us. And so if you're just starting out, you want to get that leg up, you want to just increase your learning curve, think about our one-on-one coaching sessions. All right. So that's it. I hope this video has been helpful. Do not forget to subscribe. Hit that little red subscribe button in the bottom right-hand corner of the video. Leave me a comment. Give me a thumbs up. Send me an email. I will always answer your email. Let's make these videos go viral. Tell your friends. Tell your relatives. The more likes and the more subscribers I get, the more YouTube will start showing this video to more people. All right, that's all for me today. I hope this has been helpful, and good luck on all you collar traders. I'm also going to put a couple other videos on the screen so you can keep watching. I'm going to show you some other option strategies that we like to do. So click on those. Don't forget to watch. And then down in the description below, I have links for other things that might interest you, some books that I use, some websites that I use. All right, that's all for me today. I hope this has been helpful. This is Lee Lowell signing off.